Okay, welcome back to a new video. Today we're going to be going over risk management, how I manage my risk, limit my risk, tolerate my risk, and yeah, where I set my SL and my PT. So let's get into it. So first off, guys, specifically in Forex, because it's very kind of sticking point, very textbook direct. There's one simple strategy that is very, I keep saying it, clear cut and simple. All right, so let's whip up the drawing board. Okay, now the thing with Forex, right? You don't have shares, right? You have lot sizes, right? And these lots, they're in forms of units. Okay, so these lot sizes, they're gonna be about 100K units, 10,000 units, and 1,000 units. So if we draw this out, what am I doing? Let's get that pencil. There you go. So if we get a nice little table here, that's a very fast table. Okay. Excuse the drawing. Wow, that's shocking. Okay, this should be good. I'm gonna explain what the LPP is in a second, but you guys will get it. And lot. Okay, so there are three types of categories of lots. Obviously, you can go in between that, right? But the main three that we talk about are first the 100,000 units, right? So that's one lot, right? When people say, okay, I'm sizing up, my size in this position is one lot, it means 100,000 units of this currency pair. So one lot is 100,000 units. A mini lot is 10,000, and a micro is 1,000. Okay, and then what's this LPP? So this LPP is the loss per pip, right? So we all know one pip is 1% over 100. It's 1 basis point, right? So it's going to be 0.00001. Okay, so that's 1 pip. Okay, so loss per pip, that means 1 loss per pip, if you guys kind of get it. Okay, so 1 loss per pip of 1,000 units, or 1 mini lot, is going to equal 10 cents. Okay, and then we go down. There's going to be more loss because you're taking on more size, right? So respectively, with a mini lot, your loss per pip is then going to be $1. Let's draw that sign there. And then finally, 1 loss per pip is going to give you $10, okay? So every pip that you lose, effectively, you're going to lose 10 bones, okay? Now that's for 1 lot. So it's broken down in this, okay? And then when you're managing your risk strategy, right, we all know that we like to risk 1% of the account, okay? So let's say, we're balling up big and we got a $100,000 account. 1% of that account is going to be $1,000, okay? So the equation of how we're going to identify what type of lot we should have, right, or specifically, the size at which we want to enter the trade in is going to determine on the following equation, okay? So 1% of this is 1,000, so that's going to be our risk tolerance, okay? So we're going to have our risk tolerance, okay, divided by our SL, and we're going to go over that in a second, our SL in pips. Okay, so it's not a percent, it's in pips, okay? And that's going to give us our loss per pip. And once we find our loss per pip, we can identify the lot size that's correlated with the loss per pip. Okay, so let's show you an example of this in action. Okay, so remember, our risk tolerance, the average 1% of the trade, and let's say we have $100,000 in our capital balance trading account, whatever you want to call it. Okay, so we're gonna have 1,000 divided by our SL in pips. Okay, so let's go back to a chart, for example. Okay, this is the quick US yen. So on the 1 minute, right before the close, right, I saw this triangle ascending, where it was creating new lows, new highs, new lows, new highs, right? And then, a very clear supply, or as a lot of people say, resistance point at this 141, 147 level, right? It hit double top, right? Pull back down, respected the double top, then it climbed up. This could be another double top, right? Very textbook plays, you know what's going to do. Consistent, okay? Then again, it's in this supply level. Then price starts to consolidate. When price starts to trade sideways, it could be in the form of a breakout, right? Because we saw this new higher lows, right? And then it tops off here, right? And we can see that kind of retest at the top, right? And it comes back down. So this is a clear long position, right? We would like to take some longs here because it's breaking out of that clear supply level, okay? So let's say we want to go long here. What are we going to do? We're going to enter some buys, okay? Let's say 3,000 units even, right? But we don't know what the units is yet, okay? So where do we want our stop loss to be, okay? So where do we find where's the swing low? But we don't want to go at the swing low because we can get easily whale hunted, right? We want to go a little bit below the swing low. So what we're going to do is, okay, this is fair game. Let's go at 141.085, okay? So 141.085, 141.085. That's where we want our stop loss to be, okay? So now what's happening is that our stop loss is here. It's 9 pips or roughly 10 pips down from where we want to enter the position, but then we're risking double the amount we want to risk. Okay, so what are we going to do? We're going to reduce our size, okay? So it means we want to risk only 1%. Right, there you go. Let's make it exactly 1. Okay, 1. There you go, okay? So let's not worry about this. That's going to come in a second. But here, now we know, right? So our loss per pip is 998, okay? So let's put that into the equation, okay? 1,000 divided by 9.8 is going to give us our LPP, okay? Sorry guys, the drawing. So, got my boy's calculator here. 1,000 divided by 9.8. Okay, that gives us 102. Okay, so 102. Okay, 102 times 10. Okay, wait, what's that? Okay, so our loss per pip is 102. Okay, so so that's roughly. So if the loss per pip for one lot for 100,000 units, right, is $10,000, then $10, then a loss per pip of $102 is, well, it's going to be $1,200,000 roughly. Okay, yeah, 1.4, right? So this is a very, can we even enter a trade? Oh no, it's the close. We can't enter a trade. But yeah, this is a very clear-cut way to how you can manage your risk, put your stop losses in, and yeah, be profitable. Because remember, a lot of people are gonna say, trading is like gambling, but no, you're guaranteeing your risk, you're locking in your loss, and remember, stop losses are very important too, because in those times that market uncertainty or the market makers, but they're gonna make those, large positions in, will hunt you even, because retail clients do not make the market. It's these guys, right? You want to have your stop losses in, because it's not like price comes, right? So say this is stop loss. It's not like price comes, hit this point exactly, then mentally you're thinking, okay, I'm just gonna get out here. No, usually just a very aggressive selling, right? Big red candle, right, goes through your stop loss, but you still get that execution price where you want to get out. So that's why stop loss is very important, must have, simple. All right, so see you guys in the next video. Thank you.